Hi, fellow traders. What's happening? I hope you guys had a great weekend. You're off to a good start this week. I'm a day late and a dollar short coming to you. Yesterday I went to this Dead and Company concert up in Charlotte. I know it's odd the concert's on a Monday night, but it was, and it was a pretty damn good concert. Um, Really good concert. So I had a lot of fun. Hanging out with my brother-in-law and his wife. But it was well worth it. This is why I know it's simple, but for me, the simple things mean the most. And being able to go up and spend a Monday and Monday night, you know, with family and enjoying something like that and not having to request off or ask a boss to take off or whatever. I mean, that's what this is all about. It's to give us freedom, to give us choices, so that we're not locked or we're not, stuck to anybody. Um, it was a great time. But what I want to do is the next segment in building consistency in your trading. And we'll talk about my trade from today that I took, in the afternoon. A couple of things that I want to point out with it. So we'll talk about that after I go through this segment here. And so you guys, if you haven't seen the other videos, they're right here on YouTube. I've got them in a playlist all together. It should be in chronological order. So you can start at the beginning and kind of go through it. Because as you see today, as you're going to see today, everything is built upon what I've been sharing with you. So it's all about building that foundation. So basically, just to review everything that we've gone over, it is basically to help you develop what I call a new norm. That all of the things that we had to change in order to become traders, all of a sudden it's not a fight anymore. It's our norm. It's what we look forward to. Everything that we work through to get to where we are. Establishing a process. Talking about the strategies, how to pick the right ones. Mental skills, having realistic expectations. Everything through here is what got us to this. Now, if you skipped, you took shortcuts, the higher you go, the harder you're going to fall. It's just that simple. And through all of this, what we did was we went through not every situation you're going to run into, but most situations that you're going to run into trading. And you're going to have a plan in place to deal with these things. And the more you do it, the more you practice it, the more you trade, the better you're going to be at dealing with these situations that come up. There's no way to avoid them. They're just going to come up because the market is like that. But practicing and understanding how we're going to handle everything that could come our way is what we need. And all of this would have helped you do it. And like I said, if you didn't, if you skipped, if you jumped without mastering any of this or all of this, it's a hard fall. And I'm going to be honest with you, a lot of traders do not get up from that. So today, we're at the point now where we're just insulating our trading. You know, we built the foundation. We built the base of our trading house. We framed it out. We've got everything in place. It's solid. Now all we have to do is insulate. And we're going to talk about adapting to changing market conditions. That's what we're going to talk about today. All right, safely adapting to changing market conditions. So there's some prerequisites that you have to have in order to be able to get to this point and really understand what's happening here. Okay? A solid trading process. We talked about that. The process, part of that process is our strategy, you know, our edge that we use to trade the market. You know, all of that. You know, we need to fully understand technical analysis, another part of what we went through. Again, go back to the pyramid. You'll see all of this. If you are not, if you haven't mastered your trading process yet, then you should not move forward. If you haven't mastered reading and understanding technical analysis, you don't need to move forward. If you have not been able to read and understand price action, then you shouldn't move forward. All right, and if you don't have a solid grip on your emotions, you should not move forward. Because, like I said, the bigger you go, the higher you go, and you don't have solid footing, the more spectacular the fall you're going to have. And the more likely of that fall hurting you to the point where you can't get back up. Or you may not want to get back up. And so, don't forget, all of this is what we've gone through up to this point. And if you don't feel good about it, any of this stuff, go back and go back through and work until you get it, because you gotta have that foundation. All right, great traders understand that they need to constantly adapt in order to maintain their edge in the market. You know, we that are successful, and let me tell you, just because I'm successful now doesn't mean I'll be successful 3 months from now. If I don't stay on top of what I'm doing and I get stubborn and refuse to adapt, guess what? I'm going to fail. It doesn't matter how many years I've been successful, I will fail and I won't be successful anymore. So it's important that I know that I need to adapt to the change in market conditions. So great traders also know that adapting doesn't mean making wholesale changes or throwing the kitchen sink at their edge or replacing their edge altogether in order to stay relevant. You know, the market cycles change. Sometimes they change like the wind. Look at what we've been dealing with in the market the last couple of weeks. You know, we wake up one morning, it's gapped up. We wake up the next morning, it's gapped down. We wake up the next morning, it's gapped up again. You know, and vice versa. You know, we can't come in and say, well, this isn't working, so we have to change what I'm doing, or I need to go follow this person because they're posting the most gains, or let's go to that person, they're posting the most gains. You can't do that. You have, wherever you go, you need to stick with it. If you make a change, stick with that change, and because you got to make it work. You got to learn inside and out what that person is doing. And if you can't do it, if you can't get it, and there's no way to understand it, and it doesn't make sense to you, then yeah, you need to drop it like a bad habit. But if you do good, you make some good trades, and then something changes and you want to go away from it, you don't do that. That is not the smart thing to do. Now, market conditions have undergone a substantial change since the beginning of the pandemic. If you guys remember my trading prior to the pandemic, I've made a big adjustment in my trend continuation trades. I made an adjustment because the market changed. The market dictated that I had to make a change. So I incorporated the 60-minute chart. I added, and I look at the channels that these stocks make intraday. And when I do my trend continuation, I'm trading these channels. Totally different than what I did prior to the pandemic. I stopped trading earnings the way I used to. I adapted my earnings strategy. I still look at the same stocks. The only thing is I'm trading them after they announce versus before they announce. Because at the pandemic, these companies start pulling guidance. The everything was in turmoil. So the edge I had with earnings went away. And so I had to go to another edge. And what did I do? I adapted my opening range strategy to trade earnings announcements. And it works pretty good. When we have earnings. Now, if we don't have earnings, then we don't force it. The stocks still have to meet a certain criteria for us to be able to trade it. But those traders that continued to trade the same and they didn't adapt, they haven't done well. Okay, they haven't. If they're still here. There's still many opportunities in the market, but they are quite different than what they were before. And taking advantage of what the market gives us required us to make a few changes. So if we want to be a consistently profitable trader, we have to adapt to market conditions, not make wholesale changes. We have to adapt. Now, I don't know how many of you have heard of the Pareto principle. Okay, and what it says is for many outcomes, roughly 80% of consequences come from 20% of the causes. Or you can say 80% of our trading results is going to come from 20% of our efforts. So 80% of our profits are going to come from 20% of our trading days. Think about that. The 80% of our profits are going to come from about 20% of our trading days. Think about how many big days we have. How many major days? I probably should have gone back and looked and to see how many $1,000 plus days I have versus how many days I have just average. You know, if you go back and look at that, you're going to see that only 20% of the days produce the best trading results. So what do we have to do with that other 80%? Those are the days where we end up with base hits or maybe a little red day. All right, but if we can't let those days, those 80% of those days, we can't let those days dictate anything, because we will destroy the 20% of the days when we do make money. So we have to stay focused. If you understand and embrace this Pareto principle, understanding that only 20% of our trading days produce those home run days that we look for or that we work for every day, and that the remaining 80% are going to be subpar days, but we still make progress, then it would take down that level of frustration that we have. Okay, because all we're doing every day, our job is to take what the market gives us. You know, if the market gives us gives us lemons, we can choose to make lemonade, or we can eat the damn lemons. You know, it may not eating the lemons may not taste good, but we're going to get through it. All right, we're not going to sit here and cry that the market's giving us lemons and you know, stick a thumb up our butt and not do anything. Now we're going to take what the market gives us and make the best of it. If it's only a $300 day or a $500 day, then take it. Those days add up. Those 80% days add up. All right, those 20% days are the days that make us feel good about what we're doing. It lets us know that, hey, this is incredible. And yeah, we wish that they would happen every day, but the reality is the market is not going to give it to us every day. So we accept it and be in place whenever the market is there for us. When it's ready to give it to us, if we're not there to take it, we're going to fall on our face. So there are going to be many market cycles when you will not make much progress at all. You know, these are the $200 days, the $300 days, you know, up to $500. You know, the days where you don't hit $1,000 or $1,500. Okay. You know, that doesn't mean that your trading or your trading methodology is flawed. That doesn't mean that you're not doing right. If you are making money, if your equity curve is doing what you need it to do, it looks good, you're continuing to grow your account, and you know you have a slow 2 weeks, that doesn't mean your methodology is flawed. Look at what's happening in the market. Okay, look at right now. You know, this is the lull between earnings season. You know, a lot of people are sitting around waiting. They're not trading. You know, the volume may not be here right now, so everything is a little slow. You know, so we just wait. When we recognize it's slow, we know we're not going to get the trades that we want. So let's just chill. Take what the market gives us. When it be, you know, it's simply the nature of the beast. It's just the nature of the beast. The market moves like this. We can't control it. All we can do is try and develop an edge that's going to put us in the right place at the right time. Put us on the playing field. We have our stocks to watch. If we pick the wrong one, so be it. We see 2 or 3 other stocks in our watch list do good. Know that we're on the field. We're on the right field. It just so happens the stock we picked didn't move. The market didn't give it to us. But we know the grouping of stocks that we have the potential to give it to us. And next time, we may end up with the right stock. So, when it becomes more difficult to make progress, we're in those lulls. Again, the answer isn't to push harder and to go and try to make all these wholesale changes. It's to be better prepared for when that day comes that's going to give us, that home run. Those 20% of those days when we're going to have those breakout days. That's what we're looking for. So if you're going through one of those rough patches, and most of you are, know that it's just a matter of time before the good times will return. All right, the cycle is inevitable, and it requires that we stay positive, patient, and consistent while we wait. Okay, consistent. I talk about consistency, and I talk about sticking to your strategy, sticking to your rules. Part of that consistency is knowing when to make adjustments, knowing when not to trade, knowing when you look at a stock, you look at the chart, and there's no room for it where it's at right now, and knowing that, hey, I don't need to trade this. I need to sit back and wait. It's all about being consistent with how we approach the market. How we attack the market with our strategy. If we have to make an adjustment based on market conditions, we still have to attack the market with the same mindset, that same consistent mindset, no matter what. I know you see these professional teams. They get up real big, and then they change their focus. They change the way they execute. And all of a sudden, the other team starts to come back. And, if you're playing basketball, instead of trying to score, you holding the ball longer, trying to wait, run the clock out. What it does, it kills your momentum. It kills the timing, the flow that you had. And so if the other team starts to come back, it's oftentimes really hard for you to get back in your flow. And sometimes it's detrimental for those teams. Same thing in football. The teams start running the ball more, trying to run the clock out when they've been throwing it around the field all day. When it comes time for them to try to ramp it back up, the quarterback's timing is probably off. The timing of the receivers may not be what it was. And that team could be in some really serious trouble. So, we have to stay consistent with how we attack the market. There's just no way around it. All right, so another point here. Don't try to reinvent yourself as a trader. Okay, adapt your process to the market. Okay, whatever the market conditions are, you adapt your process to it. And it could be adjusting profit-taking windows. You guys know I've been trading with my summertime rules since this pandemic hit. All right, that's just basically what it is. My summertime rules are take profit a little bit early if I have to, and on my first target, I take 2/3 off. Okay, that's how I adapt to the summertime trading. In some cases, I will size down if I need to. I'll adjust my stops, like max loss. Sometimes in these market conditions, you've got to give it a lot more room. It's gonna, oftentimes it takes out the initial technical level and tests higher levels. So you may have to adjust your max loss. You may have to adjust your technical stop to go to the technicals a little bit higher. Adjust your position sizing. So with wider stops, you gotta size down. Okay, and I'm gonna talk about this in another video. But where a lot of traders really get screwed up is they've gotten to the point where they built their foundation, they're pretty good with their strategies, and they have these really nice trades, but they can't seem to keep the money. They can't seem to keep that momentum going. It's like they know what they're doing, they understand it, but they can't put money in their account. They can't be profitable. And they're getting stopped out too soon. And honestly, once you get to a certain point, the beginner elementary mindset of, making sure that you take twice the profit that you're risking. Like if you're risking a point, then you need to take at least 2 points, or, don't do it. Once you learn how to read price action, once you really learn how to read the technicals and understand the market flow and the trend, and order flow, you're not worried about that. You're not thinking about that. I don't think about it. At the point now where I don't care about if I risk $3, then I need to make $3. Because I know if I'm risking $3, I'm going to have a target at, maybe $5, maybe $6. But I'm going to take profit along the way. I'm not going to sit there and say, well, I'm not 2-to-1, so I'm not taking profit. You have to lock in profit. Our number one job is to lock in profit when the market gives it to us. If we sit here and be stubborn and don't take it, we may not get it, and we may not ever get another chance for it. The trade I took this afternoon that we're going to look at, perfect example of it. So you're going to get to that point where you are a good enough trader where you don't have to sit here and worry about that. You're able to take more money out of the market. Where in days where you would have gone red, you may lock up $100, $200. Because I'm going to tell you, if the trade fails, if I'm risking $2 and the trade fails to go $2 and I only get $1 and some change, I would much rather be happy with a little bit of profit than a red day sitting here waiting for my stop to hit. When I know and I can read the price action and I can see that this stock is coming back. That's kind of the point I'm trying to make. But like I said, there's going to be a whole video just on that, dealing with stops and the progression that you have to make as a brand new trader, as in, say, an intermediate trader. Another thing you could do is change time frames. Now, before COVID, I could, change the summertime. I could go to a 2-minute or a 3-minute chart and trade the opening range, breakout or breakdown. But now the 3-minute is basically the 5-minute are the same. If I trade off a 3-minute, the stock is turning around if it's going to turn around. So, adjusting time frames, what I do now is I'm still looking at a 5-minute chart. But if I have a stock that's setting up early, like it's getting ready to break pre-market high or low, and I want to get in on that 5-minute candle, I'm trading it just like I would a 5-minute opening range breakout or breakdown. But it's just a quicker trade. It's going to often be within that 5-minute window, that 5-minute candle. And I'm just trying to lock in profit. Okay, and that's basically what it is. I changed that time frame because waiting the 5 minutes, I may not even get a follow through. So I'm trading whatever volatility I can get that works with my edge. So we know poor market conditions require shorter time frames and less hold times. If we're in a bad market, just like we're in now, the opening trades, they work for about 15 minutes. After that, the market tends to go flat. And any other moves we get are going to, be forever. So at the open, we need to deal with these shorter time frames or less hold times. Okay, we shouldn't look at bad markets with suspect price action negatively. These markets are terrible. But remember the 80-20 rule. Okay, only 20% of the days are going to be really good days. All right, 80% of these days are going to be bad days. Low volatility, low volume, low momentum. All right, but there are always going to be opportunities. If you've been with me long enough, there was a time where every day I would cry about the market sucks, the market sucks, the market sucks. And once I learned about that 80-20 rule, it's given me a new understanding. The market can suck, it can be bad, but it can still give us opportunities. We can't force it. If it's not there, it's not there. But there always seems to be opportunities. We just have to work to put ourselves in the right place. Okay, that's what it boils down to. Okay, so we adapt our thinking and approach and take advantage of what the market gives us. It's exactly what you see, what I've done over the last couple of years. All right. So the trend is your friend, one way or the other. All right. Just because the market's gapping down doesn't mean that you have to chase stocks short, or vice versa. If the market's gapping up, you don't have to chase stocks long. All right. And you guys know, for me, sorry, hold on a second. You guys know, for me, what's my saying? What's my saying? If the market's gapping up, I'm going to look for initial value to the short side. It has to be a significant gap up now. If the market's just trading up $1 or something, no. I'm talking about a significant gap. So if it's gapping down significantly, I'm going to look for the move to the upside. If it's gapping up, then I'm going to look for a move to the downside initially. Now, the market can still recover and keep going in the same direction, but I'm talking about the initial value, the first 30 minutes of the day during the time that we trade the morning. So markets that are gapping down often offer some of the best counter trend trading. The biggest bounces almost always occur in bad markets, or markets that have sold off significantly, a big gap down. That slingshot effect, when things become stretched to the downside, can offer great opportunities. It's easier for stocks to go down than up, so they tend to stretch out to the downside more, and those give explosive moves down if you catch it down, and reversals. It can give you a real good move to the upside, but the market has to be trending pretty good in that direction. But just know, it doesn't matter that there are counter trend trades in the market. Just because it's selling off doesn't mean you can't catch a nice day trade to the long side. Okay, some of the best trades can be that recovery, and a lot of times it's right at the open. So it's a matter of paying attention to the market, understanding where your opportunities lie, and then adapting your strategy to it. That's basically what it is. It's what I try to teach. And again, I can't teach it. Trying to teach it in a video, trying to teach it, without you actually seeing and understanding what's happening in the market, it doesn't really make a whole lot of sense. So that's why I say the chat room is the classroom. Okay, that's where the true learning takes place. That's where the rubber meets the road. That's where the light bulbs go off. So just to kind of show you what I did today. So AFRM was nice breaking the channel here, and I got in. It pulled back a little bit. It almost kind of reached my target here. But when we pulled back and it put in this candle, I was going to take the profit. All right, but by the time I got ready to cancel the order, this thing had washed out. And we were really close to my entry here. So I'm like, okay, I can't. I'm not going to take it off here. So I let it try to bounce. It got rejected at the top of this channel again. And it sold off. And I was waiting for it to bounce off the 50. Because the 50 is typically what's holding it. You can see it pulled back here to the 50. Pulled back here to the 50. So this is pretty much what was holding it. So this is me not worrying about my risk reward so much, but reading the chart, looking at what this chart has in store and what the potential is. Okay, I know how much I'm willing to risk in order to see if this is going to work out the way I want it to. If it halfway works out, I'll make a couple of bucks. Worst case scenario. If it doesn't work out, no problem. I've already spent the money. Because in my mindset, when I take a trade, when I spend that money, when I take a trade, whatever I'm risking is what I'm saying I'm spending to trade this stock. And so if I'm risking $300, that's how much that trade cost me. And so now I'm just looking to take whatever money it's going to give me. I mean, that's how I look at it. So I'm not worrying about if the trade loses because I've already written that money off. What I'm focusing on is what does this market want to give me here? And so when it popped up here, we did make a higher high. It pulled back here. We did make a higher low. So technically, I'm still in play. It may get a boost. A lot of times I've seen these get a boost after the market closes, after 5 o'clock, 6 o'clock. I've seen it jump up. But, you know, all of this is, it ran up. It didn't allow me to take profit. My whole plan was I was going to take profit after I saw that price action. That was the adjustment I was making. Now, I'm just having to work the trade out. Whatever it takes, as long as technically it's in play, the trade is in play. I mean, it's the trade is still valuable. So that's what it's all about for me. But this was a really prime example, and this can happen. You know, I waited for it to put in this. When I saw this candle, this is a telltale sign that we're coming in. So I was ready to lock in 2/3 right now. Okay, it's not where I wanted it to go. I wanted 143.25, but it wasn't gonna make it, and I would have much rather locked in, you know, maybe $200 or so, and get stopped out at break even, than having to go through what I'm going through here. You know, but I'm not upset about it. I know that the trade is still viable. I need to keep my head about it and continue to work it out. And that's what it boils down to. So that's me for the day. Not done yet. No, obviously it is aftermarket, but it's not. I'm not done yet. You know, I'll trade up till 8 o'clock sometimes, if the opportunity is there. But I'll just leave this on and keep checking on it to see if it does anything, and then based on what I see, you know, what I'll do, and we'll do it right now. Why not do it right now? Let's look at the daily chart before we go off. I'm loving this chart, so I'm likely to leave this on. I mean, I'm loving the chart. 52-week highs right here on 146. I love it. So, you know, I may just leave this on overnight to see what it does. It looks pretty good. But that wraps it up for me today. I hope this segment helps you out. If you have any questions, as always, email me at AverageJoeTrader.com. I'll be more than happy to help you out. So you guys have a good one, and I'm going to go get ready for hump day tomorrow.